Some big changes ahead for the nation's biggest banks. The Federal Reserve approved today a new set of rules requiring banks to increase the amount of capital they keep in reserve. This is to help prevent another financial crisis and any future taxpayer bailouts. The new rules would require banks to raise the minimum capital requirement by an additional $4.5 billion. Most banks are already in compliance, and about 100 other banks need to comply, but they have until the year 2019. The rules are expected to be approved next week by the Federal Deposit Insurance Corporation and the Office of the Comptroller of the Currency.
And joining us now to talk more about this, Moshe Orenbuch. He is a banking analyst at Credit Suisse. Moshe, good to have you with us. I want to talk about the big banks specifically, as the Fed and the FDIC seem to be targeting those large, quote, systemically significant banks with these new rules and potentially some new, tougher leverage ratios down the road. As these banks get safer, I presume, will they get necessarily smaller, and will they still be able to generate profit growth?
So I think the answer to that is they probably won't get materially smaller, but it has put a constraint on their ability to grow. In terms of profit growth, we are optimistic that they will be able to generate reasonably good profits and returns. To some degree, it does depend on where that leverage ratio goes. The higher it goes, the more difficult it will be.
The one thing that most Americans always worry about is how safe are these banks? So you talk about the rules limit their ability to grow. Are these banks, because of these new rules, much safer today?
Susie, absolutely. I mean, they are significantly safer because they've reduced the risk inside their loan portfolios, inside their other activities, and their capital levels and liquidity levels are significantly higher.
Among the class of large banks that you follow, which ones do you think are best positioned to take advantage, number one, of a new, tougher regulatory environment, and number two, of the economic environment that you see?
Sure. So, I think that the way I would think about this is that J.P. Morgan has been really able to kind of manage through this and generate a 14 or 15% return on capital during this entire process. Even last year when it had some difficult problems. So I think they're in a pretty good position. I think the second name that I would mention is Citigroup because it derives the bulk of its profits from outside the U.S., and therefore I think over time has got better growth opportunities.
Moshe, I know you cover the big money center banks. You really don't focus as much on the regionals, and I don't want to put you on the spot, but we've been seeing a lot of these smaller banks hitting 52-week highs in the stock market. What's going on there? What can you just tell us generally?
So I think generally what is going on is because long-term interest rates have risen, there's a feeling that that's good for banks. Because in general, when the difference between short-term and long-term rates is large, that tends to be good for banks. In this situation, I think you're going to have to wait till the Fed actually increases short-term rates for it to be a positive. And in the interim, it could be a little bit of a negative for banks. And so I'd be a little bit cautious about the ones who've had some of those big runs.
How important to the health of some of these larger banks is the health of the housing market in the U.S.?
So the housing market is critical. It's the largest financial market in our country, and banks finance it. It's important to every single one of the banks in slightly different ways. Even Citigroup, which, as I said, derives the bulk of its profits from outside the U.S., has got some pretty big exposures in U.S. housing and will benefit as housing does get better.
Moshe, we have half a minute. Just wondering, earnings season's coming next week. What can we expect from the banks, these big banks?
So always the big banks with capital markets activities, second quarter is a little weaker than first quarter. The first part of that was pretty good, and so I think we hope that it won't be too difficult. But you're going to see it's a grinded out kind of situation where it's blocking and tackling, getting your costs down and controlling them because it's a low growth environment for the industry broadly.
Moshe, thank you very much. Moshe Orenbuch, banking analyst with Credit Suisse.